Imagine waking up one morning to find out that your monthly mortgage payment, the one you've carefully budgeted for years, is about to jump by over $1,000. Not next year, not in 5 years, but in just a few months. This is not a hypothetical scenario. This is the reality hitting millions of Canadian homeowners right now, and the shock waves are tearing through families, neighborhoods, and the entire housing market like never before. What's happening in Canada right now is nothing short of a financial earthquake. And if you own a home, know someone who does, or are even thinking about buying one in the future, you need to understand exactly what's unfolding. Before we dive into this critical story, if you're new here, make sure to hit that subscribe button and turn on notifications so you never miss an update on the stories that affect your wallet, your family, and your future. Now let's get into what's really going on. The Canadian housing market has been the envy of investors and the nightmare of first-time buyers for over a decade. Prices soared to astronomical levels, especially in cities like Toronto and Vancouver, where average home prices exceeded $1 million. People stretched themselves thin, taking on massive mortgages with the confidence that low interest rates would last forever. But forever came to an abrupt end. Starting in 2022, the Bank of Canada began one of the most aggressive interest rate hiking campaigns in the country's history. In just 18 months, interest rates went from near 0 to 5%. That might not sound dramatic if you're not familiar with how mortgages work in Canada, but let me put it in perspective for you. Unlike the United States, where 30-year fixed-rate mortgages are the norm, most Canadian homeowners have mortgages that reset every 5 years or less. That means even if you locked in a low rate back in 2020 or 2021, you're now facing a renewal at rates that are more than double, sometimes triple, what you were paying before. We're talking about families who were paying $3,000 a month suddenly being told their new payment will be $4,500 or even $5,000. For many, this is simply not sustainable. Let me tell you about a family in the Greater Toronto area. They bought their home in 2020 during the pandemic housing frenzy. It was a modest 3-bedroom house in the suburbs, nothing fancy, but it cost them $850,000. They put down 5% because that's all they could afford, and they secured a mortgage at 1.8% interest. Their monthly payment was around $3,200. Tight, but manageable on their combined income of $140,000 per year. They were living the Canadian dream, or so they thought. Fast forward to 2024. Their 5-year term is coming up for renewal, and they've been hit with the new reality. Their renewal rate is now sitting at around 5.5%. Their new monthly payment will jump to over $4,800. That's an increase of $1,600 every single month. An extra $19,200 per year, money they simply don't have. They've already cut back on everything. No more family vacations, no more eating out. The kids' extracurricular activities have been canceled. And still, they don't know how they're going to make it work. This family is not alone. According to recent data from the Canada Mortgage and Housing Corporation, approximately 2.2 million mortgages are set to renew in 2024 and 2025. That represents nearly half of all outstanding mortgages in the country. The Bank of Canada has estimated that these renewals could see average payment increases of between 30 and 40%. Some estimates put the total impact even higher for those who locked in at the absolute bottom of rates during the pandemic. The term that's being thrown around now is the mortgage cliff, and it's an appropriate name. Imagine millions of homeowners all approaching the edge of a financial cliff at the same time. Some will find a way to step back, others will fall. The Canadian Bankers Association has reported that mortgage delinquencies have already started to tick upward, though they remain low by historical standards. But the real wave of distress hasn't even hit yet. Most of those pandemic-era mortgages don't renew until late 2024 through 2026. We're only seeing the beginning.
What makes this situation particularly cruel is how it's affecting everyday working families. These aren't speculators who bought multiple investment properties. These aren't wealthy individuals who can absorb the hit. These are teachers, nurses, firefighters, and small business owners who just wanted a place to call home. They followed the rules. They saved for their down payment. They got pre-approved by the bank. They were told they could afford it, and now they're being crushed by forces entirely outside their control. The psychological toll is immense. Financial stress is consistently ranked as one of the leading causes of anxiety, depression, and relationship breakdown. Credit counseling agencies across Canada have reported a surge in calls from homeowners seeking help. Many are embarrassed to admit they're struggling. They look at their neighbors and assume everyone else is doing fine. But behind closed doors, kitchen tables across the country are covered with spreadsheets, bank statements, and desperate calculations trying to make the numbers work. Some homeowners are making impossible choices. Do they dip into their retirement savings? Do they take on a second job, sacrificing time with their families? Do they rent out a room in their own home to a stranger? Do they pull their kids out of activities they love? These are the real human decisions being made right now, and they're heartbreaking. The impact extends beyond individual families. When homeowners are forced to cut back on spending, the entire economy feels it. Local businesses see fewer customers. Restaurants sit half empty. Retail stores struggle. The ripple effects touch everyone, even renters who don't own property at all. Some economists are warning that this mortgage shock could tip Canada into a recession if it's not managed carefully. Let's talk about what the banks are doing. To their credit, Canadian banks have implemented some measures to help struggling borrowers. Extended amortizations have become common, allowing homeowners to stretch their payments over a longer period to reduce monthly costs. Some lenders are offering interest-only payments temporarily. Others are allowing borrowers to skip payments entirely for a short period. But these are band-aids on a wound that requires surgery. Extended amortizations mean paying more interest over the life of the loan. Interest-only payments mean no progress on paying down the principal. Skipped payments get added to the balance, increasing what you owe. These measures provide short-term relief but long-term pain. The federal government has also stepped in with some measures. The Canadian Mortgage Charter, announced in late 2023, outlined principles for how lenders should work with struggling borrowers. It includes provisions for waiving fees on relief measures and ensuring borrowers aren't penalized for seeking help. But critics argue these measures don't go far enough. They don't address the fundamental problem, which is that housing in Canada became so expensive that people had to take on dangerous levels of debt just to have a roof over their heads. Here's a statistic that should alarm everyone. Canada now has one of the highest household debt-to-income ratios in the developed world, sitting at around 180%. That means for every dollar of disposable income a Canadian household earns, they owe $1.80 in debt.
Most of that debt is mortgage debt. We've built an economy on borrowed money tied to ever-increasing home values, and now the bill is coming due. Some experts are pointing to the housing market itself as part of the problem. Despite the interest rate hikes, home prices in many Canadian cities have remained stubbornly high. Basic economic theory would suggest that higher rates should lead to lower prices, as fewer buyers can afford to purchase. And we did see some price declines in 2022 and early 2023. But prices have stabilized and in some markets started climbing again. Why is this happening? Part of the answer is supply. Canada simply doesn't have enough homes. The country has welcomed record numbers of immigrants in recent years, which is generally positive for economic growth, but the housing supply hasn't kept pace with population growth. This keeps demand high even as affordability crumbles. The result is a market that makes no sense to ordinary people. Prices are too high to afford, but they're not falling. Interest rates make borrowing expensive, but people feel pressure to buy anyway out of fear that prices will rise even further. First-time buyers are locked out entirely, watching from the sidelines as their dream of homeownership slips further away. And existing homeowners are trapped, unable to sell because they'd either take a loss or wouldn't be able to afford to buy anything else. Let's talk about what might happen next. The Bank of Canada has signaled that interest rate cuts could be coming, possibly starting in mid-2024. Markets are pricing in the expectation that rates will gradually come down over the next year or two. This would provide some relief for homeowners renewing their mortgages, but don't expect a return to the ultra-low rates of the pandemic era. Those rates were an emergency response to an unprecedented global crisis. The new normal is likely to be somewhere in the 3 to 4% range, which is still significantly higher than what many borrowers locked in at during 2020 and 2021. Even with rate cuts, the damage may already be done for some families. Those who've depleted their savings, maxed out their credit cards, or fallen behind on payments will carry those scars for years. Credit scores take time to rebuild. Savings take time to replenish. The stress and strain on relationships and mental health don't disappear overnight. There are also concerns about what happens if the economy weakens further. If unemployment rises, homeowners who were already stretched thin could find themselves in an impossible situation. Job loss combined with an unaffordable mortgage is a recipe for foreclosure. And while foreclosure rates in Canada have historically been much lower than in the United States, the conditions have never been quite like this before. The combination of high prices, high debt levels, and rapidly rising rates is unprecedented in Canadian history. Real estate investors and analysts are watching closely. Some see opportunity in the distress. They're waiting for forced sellers to flood the market with properties at discounted prices. Private equity firms and institutional investors have been increasingly active in Canadian real estate, buying up single-family homes to convert into rentals. If a wave of foreclosures does hit, these deep-pocketed buyers may be the ones snapping up properties, further concentrating home ownership in fewer hands. For the average Canadian watching this unfold, the question becomes, what can you actually do? If you're a homeowner facing renewal, start preparing now. Don't wait until the last minute to understand what your new payment will be. Use online mortgage calculators to estimate your costs at current rates. Talk to your lender about your options. Shop around with mortgage brokers who can access multiple lenders and potentially find you a better deal. Consider whether you have room to make extra payments now to reduce your principal before renewal. If you're truly in distress, don't suffer in silence. Reach out to a credit counselor. Many offer free consultations and can help you understand your options. Look into government programs that might be available in your province. Talk to your lender before you miss a payment, not after. Lenders have more flexibility to help when you're proactive rather than reactive. If you're a renter thinking about buying, be extremely cautious. The fear of missing out is powerful, but buying at the wrong time with the wrong terms can set you back financially for decades. Make sure you test your own finances. Could you afford your mortgage if rates went up another % or 2? If not, you may be taking on more risk than you realize. There's no shame in renting. Despite what real estate culture tells you, owning a home is not the only path to financial security. The broader lesson here is about the risks we take as a society when we treat housing primarily as an investment rather than as shelter. For decades, Canadian governments at all levels have implemented policies that encouraged home ownership and protected property values. Those policies helped existing owners build wealth, but made housing increasingly unaffordable for each subsequent generation. Now we're seeing the other side of that equation. When everyone is leveraged to the hilt based on the assumption that prices will always rise and rates will always stay low, a sudden change in conditions can bring the whole system to its knees. Some advocates are calling for more dramatic interventions. Ideas like government-backed rate relief programs, emergency funds for struggling homeowners, or even temporary freezes on foreclosures. Others argue that market forces should be allowed to work, that a correction in home prices, however painful, is necessary to restore affordability and balance to the market. There are no easy answers, and whatever path is chosen will create winners and losers. What's clear is that Canada is facing a reckoning. The choices made over the past 2 decades by policymakers, by lenders, and by individual borrowers are now coming home to roost. The pandemic accelerated trends that were already dangerous, and the hangover is brutal. Millions of families are caught in the crossfire, forced to navigate a situation they never anticipated and never chose. As we watch this story unfold in the coming months and years, remember the human faces behind the statistics. Remember the parents lying awake at night, worried about how they'll make next month's payment. Remember the young couples who saved for years only to find themselves trapped in a home they can barely afford. Remember the retirees who counted on selling their home to fund their golden years, now uncertain if the value will hold. The Canadian mortgage shock is not just a financial story. It's a story about dreams, about security, about what it means to have a home in a country that has priced so many out. Whether you're directly affected or watching from the sidelines, this is a moment that will shape the economic landscape for years to come. Thank you for staying with me through this important story. If you found this video valuable, please take a moment to hit that like button, because it really does help more people see content like this. Drop a comment below sharing your thoughts or your own experience with the mortgage situation in Canada. And if you haven't already, subscribe to the channel so you can stay informed on the stories that